Hi, and welcome to this week's episode of Come to Find Out. This week we are going to be talking with Chris Kirkpatrick from Lower.com, and he is a lender that I work with frequently, and he also is really passionate about first-time home buyers just like I am, and so I asked him to come on here and talk about some of the different things that go into purchasing a house. So when you're looking at purchasing a house, obviously you're going to be talking with your lender about what is my monthly payment and what is my budget and things like that, but there are also costs that kind of also roll into buying a house that sometimes people don't think about. So I asked Chris to come on today and to give us some information. So thank you so much for coming.
Thank you for having me. I appreciate it.
Yeah, of course. So what else other than, obviously whenever you're talking with a client and, you're helping them kind of get prepared, what are the different costs associated that, they need to have in mind when thinking about buying a house?
Yeah, absolutely. That's always important stuff to know so that way you're well prepared going into the transaction.
Yeah.
The biggest ones are going to be the down payment, the closing cost itself, the earnest money deposit, and then some items that are also be out of pocket before the actual closing occurs, being the home inspection and the appraisal as well.
Perfect. So what would you say people should estimate for your down payment?
Yeah.
I know that there are different programs, like FHA, conventional, things like that. So what are the different amounts that people should maybe get prepared for?
Absolutely. So there are options even as little as zero down, but your most common programs that you'll tend to see will be at 3 and 3.5%. That's what a lot of first-time home buyers are able to utilize. Beyond that, you then bracket it by 5%. So going to 5, 10, or 15% down, and then the magical 20%. 20% is not required in any way for a home transaction, but what it does avoid is a PMI on the loan. So depending on the scenario, that can be a good option, but especially for first-time home buyers, being able to exercise the 3 or 3.5% is a very valid option. So that will always be based on the purchase price of the property. So if you take that by that percentage, that would be your base investment or down payment onto the property. That goes directly into the loan itself. So when you look at the purchase price and then you add the down payment to that, that's reducing the loan amount so that there's the equity in the property as you're going to close.
Oh, okay, perfect. So the 3%, 3.5%, things like that, that's just based on the purchase price?
Yes, yep. So it's always going to be on the price point of the home. So on the $100,000, on 3% looking at $3,000, 3.5% looking at $3,500. And I like sharing both of those because FHA is a very valid option for first-time home buyers at 3.5%. A few years ago, conventional updated to be able to do 3%. So depending on the criteria, that can be a very valid option available for first-time home buyers. So.
Oh, okay, perfect. And then, so you mentioned something about inspection and appraisal and things like that. So obviously when you're going through, the home buying process, once you get into contract, yay, we're super excited. And then, the next step is the inspection. And, earlier, on an earlier episode, we had an inspector on and, they estimated that it's anywhere from $350 to, $500, just kind of depending on what you need, or if it's a condo, it's a little bit less. So that would be one amount to kind of keep in mind. What is the appraisal, what is the amount for the appraisal that you should count for?
The appraisal, I would say to judge about $500 to $600 would be a good bet on that. It can depend a little bit on the home size or any unique characteristics based on the property. But these are important items because these are the ones that are out of pocket before the actual closing or consummation of the loan. So it's always good to be prepared, knowing what those amounts are. So I say $500 to $600 is a very good estimate to keep to the side for the appraisal cost, and then as you mentioned, the home inspection as well.
Oh, okay, perfect. So, and then are there any other additional costs? Are there closing costs? And what does that look like? Is there a bank fee, or is there a thanks for using Crispy?
Not at all. I don't charge extra for that.
Oh, okay, good.
We always just want to give the best service. But no, that's a very valid question as well. And it's nice to be able to break down the down payment, or the closing cost into certain sections. So you obviously have the down payment amount, and that's going to be separate compared to the closing cost. Now, as a good estimate for this, I think a good rule of thumb to share is about 2 to 3% of the price of the home is a good estimate to have in mind as a buyer. I share that as a range because as the price point goes higher, if you're up at 400,000 or 500,000, it's going to be more close to the lower percent of 2%. There's certain items in the loan that are going to be more of a fixed fee, which I'll touch on in a moment. But as you get higher up on that purchase price, I would probably lean more towards about 2% as being the actual overall cost. If the price point of the home is 250, 350-ish, it could be closer to 3 just because certain items are going to be a flat amount rather than as a percentage of growing with the loan. So then as that breaks down, what you end up having is the individual fees with the lender and what they charge. Then you're going to have your title insurance and title cost, and then your escrows, which are also called prepaids. I always include that as part of closing cost, but it is considered prepaid for a reason. It's actually not a fee that the lender or anything is charging to you. It's taking the insurance policy and the taxes for the home, getting those set up into an account on the side so that they're ready to be paid out as the bills come due. So as the lender, I would always say, from my years of experience, a good estimate to have in there is probably $1,000 to $1,500. The Greater Columbus market is very competitive, so it's rare to see really any fees past that. But truly, this is the one item that the lender does individually charge. So that is separate of then the title and your prepaids. But basically, lender to lender, that's the one section that can change or vary depending on how they're doing it. But that would be called your origination fee or origination charges on the loan. That's the fee coming from the lender to create the loan for you. Then from there, you will have your title insurance. Now, title insurance in Franklin County is going to be picked by the seller. So they will also tend to pick up a good amount of that cost, but there is some to the buyer as well. I think as a buyer, I would expect about $1,500 to $2,000 is a good amount to have in mind for what the overall title cost would be on the buyer side. The remaining amount of anything on the title order is typically going to be picked up by the seller as far as the owner's policy and other items since they're the owner of the home. So there's just going to be minimal stuff there from the title. And what this does is ensures the title to come to the buyer clean and clear of any encumbrances. So that way when you get the keys to your home, you know that everything is absolutely fine and that you have full ownership right in the property.
Yeah, perfect. So so I guess what you're saying, just to make sure that everyone listening is following along. So you would have not only are you going to be looking at like your monthly payment price, and making sure that works for you, but you also need to make sure that you have a little bit of money set aside as well. So you've got the closing costs, you've got the down payment, you've got the appraisal, and you've got the inspection. Are there any other additional fees that kind of go on the lending side that they need to keep in mind?
Yeah. The last part to touch on would be the escrows or prepaids, because it is cost as far as what's coming to the table at time of closing. So it's great to be prepared for those items. But that will it can vary property to property, but to give the information, the actual home insurance is going to be property specific. So whatever that dollar amount is from the quote that you obtain, and you're able to shop around, find out the best offers, the best coverages that fit your needs. And when you have that, basically we'll take that quote and include it as part of the amount that you do bring to the closing table. The way that the homeowner's insurance will work is that you'll actually pay for 1 full year at the time of closing. And basically it's one of those things where you have to pay to then have the insurance. So you will at that point be covered for the next 12 months for a full year. And what we then do is we're creating an escrow account so that every month part of your monthly payment will also have the taxes and insurance going into that, so that 1 year later on that same month we'll be ready to pay out the insurance policy again to be covered yet again for another year. The other one would then be the taxes, and can vary only because it's the taxes on the specific home. So depending on what those taxes are as a monthly payment and when we're closing in the month, there will be taxes due in January and June. Some counties will also do February and July, but it tends to be January and June. And so depending on when we're closing within the year, we will create the account to make sure that those items are paid out accordingly. One thing that is really nice though as well as a buyer is that you're going to enjoy what's called a tax proration credit from the seller of the property. So while I bring these items up because it's important to know about them, they're also heavily offset, and that's one thing that's really nice here. Not not every area will do a tax proration. So what that simply means is that the tax bills that come due in Franklin County are actually due from a past time period. So while I'm creating this escrow account for you to have all these items paid, there's actually going to be the first bill that comes due is going to be from a time period where the buyer wasn't living in the property. So because of that, the seller will pass forward a tax credit to the buyer for that first bill. So as we create the account, it's also heavily offset by the credit given by the seller, and then everything then continues to roll forward with part of the monthly payments going into the escrow account.
Nice. Yeah, I like to think of escrow accounts as kind of like these little buckets that sit over here. So, whenever you're making your monthly payment, they're taking part of it and putting it in principal and interest. Obviously, correct me if I say something incorrect, but they put it over here in the big bucket for principal and interest. But then there's another little bucket over here that's just for your insurance, and another little bucket that's for your taxes. So that way, you don't have to worry about coming up with a large amount, in June and in January every year. It's just coming out. So in your monthly payment, they're taking that and they're moving it into the different buckets for you. Yeah. So hopefully that makes a little bit more sense. But please correct me.
You did a very good job there, Sarah.
Thank you.
And I like the example of a bucket because that's actually something I really like to explain for clients because it can be confusing sometimes. There's a lot of bills in our life, car insurance being one of them, that are done on a monthly basis. The actual bill itself being paid. When it comes down to the monthly housing payment, it actually is exactly that. It's going into a bucket. And I like to describe that because it's not necessarily every month going directly to the county auditor for the taxes. They do it semi-annually. And same with the insurer. They're actually going to collect on an annual basis. So while it is a part of your monthly payment, it's truly going into one of those buckets, your escrow account. That then is sitting there ready to be paid out when those bills come due. So yeah, that's exactly.
Perfect. Thank you. Yeah, see, I do listen whenever he talks.
She does.
I love it. Excellent. So is there anything else that you can think of that we haven't covered with like down payments that you think that, first-time home buyers or anyone that hasn't bought in a while, is there any other costs you can think of that they should maybe keep in mind?
Yeah. Nothing that jumps right out to me. As far as a lot of the items that we covered are going to be, the standard ones in a transaction. The only other thing that I could, think of is if there was any kind of, negotiation with like repairs or things like that. Again, that's mostly typically going to be done by the seller. But if for any reason there was, some kind of an agreement or something like that where the buyer would then be expecting to, have something put into it there. But truly, you really are just going to have your origination fees from the lender, your title insurance cost, and then your escrow and prepaid accounts. So that's really the majority or basically everything on the transaction. And then, to be prepared for those items that do happen before the actual consummation or closing of the loan, being the home inspection and home appraisal. So if we're, prepared for those items, then you're going to be sitting in a good spot. And it's really nice to be able to, have and know this information. I always say it's best to be prepared. Knowledge is power. And especially when you're buying a home, it's one of those things where, it might not, we do this day to day. It's part of our life. And I always understand that for most individuals, it's not something that they're going to do all the time. It could be just a few times in their life. And so, always want to work with a great team and, pride yourself on being able to, explain and give that kind of great service. I think one thing that's nice to bring up though, because as you mentioned, as far as depending on how long they've owned a home, I always think this is really good information to share because I don't think it's something that everybody knows. But a first-time home buyer is, exactly as it sounds. If you're truly a first-time buyer and you've never owned a home in the past, but they also look at it as if you haven't been on title or owned real estate in the last 3 years, you actually qualify for being a first-time home buyer again.
Oh,
so
that's nice.
Yeah. So kind of loop in some of those lower down payment options that we were just discussing that a first-time buyer has the right to exercise, and they're really nice and there for those reasons to be able to get you into a property, start building that equity and that wealth, and in the best way tends down the road maybe do other things as the equity grows, but to be able to get into that property at a very low barrier of entry. But yeah, so even if you've owned a home and it was years ago and maybe life has changed and you're looking back into the market again, if it's been 3 years or more, you could also look at exercising a first-time home buyer program. So that's really nice to know as well.
That is great.
Yeah.
That's so great to know. So hopefully that's a good little tidbit for you as well. So Chris, thank you so much for coming and joining me today. So you gave us a lot of great information.
Absolutely. Thank you for having me. I appreciate it.
Yeah, absolutely. Thanks so much for joining, and look for us next week on Come to Find Out.